Hi, this is Charles Kelly. Welcome to UK Property Talk and Money Tips podcast. Well, there's more bad news for the economy this week as the Bank of England raises interest rates for the highest rate in 27 years. They've raised it by 0.5%. That means the highest increase in 27 years. They normally go up by smaller amounts, like 0.25% here and 0.25% there. But they've jacked it up to 1 3/4 now, 0.5%, quite a surprise. And they are now saying that the UK is heading into recession, or should I say, they're now admitting that the UK is heading into recession. And, you know, they are at the steering wheel here. They and the government are the ones steering us into this recession. And obviously higher interest rates are going to push us further into recession, as it has done in the States, where they've already gone 2 quarters of negative growth. Officially, a recession is 2 consecutive quarters of negative growth, and America's already had that. We haven't had a negative quarter, but the Bank of England now, not me, are saying that we're heading into recession. A lot of us already know that in reality we are in recession because the economy is not growing. Now they're also saying that inflation will hit 13%. Now, they were saying 11% before, but now they're saying 13%. I think by autumn, sometime in October, it will hit 13%. So that is likely to happen. These are the same people that said inflation was transitory, it was temporary, it would go up a little and come down again. Somehow I wonder if these guys have even got a clue. I mean, they're all very smart economists and that sort of thing. But I saw the governor, Andrew Bailey, sitting there being interviewed by the press saying, this is a tough time for all of us. No, Andrew Bailey, it's not a tough time for all of us. It's a tough time for ordinary people, but not for you sitting there on your, I think they probably earn hundreds of thousands, if not $500,000 a year to be the governor of Bank of England, guaranteed pension, guaranteed job for life. You are not having a tough time. So don't try and empathise with people by saying it's a tough time for all of us, because it just doesn't wash with me. Now, you don't have to have a tough time, by the way. You can make any recession, you can come through it thriving. You don't have to say, well, it's a recession, that's it, I'm giving up, I'm going to just hide under the duvet, there's no work around, there's nothing around. No, there is work, there's actually employment around. A lot of people are already doing second jobs to pay for these higher fuel bills, which is not necessarily the bank's fault, but the bank, inflation had already started with money printing, quantitative easing before this war and before the oil crisis. So let's get that one out of the way. So they're saying that we're heading into trouble. Interest rates going up is designed to curb inflation. It's a blunt instrument designed to sort of cut down consumer spending. They're also going to offload a load of government bonds, or gilts as we call them here, by 80 billion worth of government bonds in September. So I guess that will slow things down. But they've got this silly inflation target, I think, of 2%, which, okay, it's fine, but they're going to take measures to meet a 2% inflation target, where they could just perhaps increase that inflation target. But although they say that is the government to decide. They also said that the average inflation rate over the last 20 years has been around 2%. And interest rates have been around that sort of level. So look, you know, we're paying now for quantitative easing on a mass industrial scale. We're paying for this printing of money, if you like to call it. It's not technically printing of money, but it's a kind of way of creating more money. We're paying for the mistakes made in the last financial crisis when the Bank of England were asleep at the wheel, and because of the crash then. We've seen quantitative easing since 2008 on a mass scale, which is now causing inflation, and it's causing other problems. It's causing a bubble in the stock market, and it could be a bubble in the property market as well. It's certainly created this bubble. Don't forget, property transactions in June were down 55% on 2021, which means there was this boom created last year by the stamp duty holiday, you know, that Rishi Sunak, who was the hero then, now he's running for Prime Minister. He doesn't get my vote. But, you know, that's created this bubble that we're in now. And now prices have gone so high that, you know, it's pushing people out of the market. But mortgage. And another thing the Bank of England did about a week ago is they started to relax mortgage affordability rules, and I'll just come back to that in a little while because that's quite an interesting thing. They've relaxed the stress test, but again, if that had any effect, it would have the effect of pushing up prices and creating more inflation, wouldn't it? It doesn't quite make sense to me. But interest rates rises should be good for savers, right? But it's not, is it? Because let's face it, the average high street banks, they should be increasing rates. We've had 5 interest rate rises. That's 5 banks: NatWest, Halifax. Just remember that: NatWest, Barclays, HSBC. There's been 5 interest rate increases in the last couple of years. Why haven't your interest rates for savers gone up significantly as you've put up credit card borrowing rates? Now, if you've got credit card debt, you need to get that paid off, because you're going to be paying 18-20% on your credit card and earning less than 0.5% on your savings. So that's what's happening. I've written about this. I've said the banks are ripping people off, which they are. And millions of savers are really stuck in these accounts because of inertia, because they can't be bothered to move their bank account. It's one thing that people will move their electricity account, they'll move all sorts of things, but not their bank account for some reason. And now that the banks are closing down branches all over the place, it's making it even more difficult to go in and talk to someone about even just moving your money from one account to the other and getting a higher rate of return. So what can you do to make the most of your savings? Well, here's 3 little quick tips for you. Look further than the high street banks. The high street banks, frankly, they don't need your money. You know, they've got so much money sloshing about. They're not that keen on attracting savers, so they've never really given very attractive rates. So the well-known banks are not going to pay the high. You have to really look online. You have to look further than the high street banks. Remember also that your savings are only protected by the government scheme up to £85,000 per banking license. So if you've got money, say with the Halifax and Lloyds, that could be under the same banking license. Don't quote me on that. But certainly if you've got different accounts with the same bank, then you're only protected up to £85,000 if that bank failed. Very unlikely the banks fail, but they have failed in America. We bail out banks here that fail with taxpayers' money, us. But just think about that. You might want to move your money around. The other thing you can do is tie up your money for a bit longer. Talk to your bank and say, look, if I put this money with you for 6 months, a year, because a lot of people, I know someone that's got money sitting in the bank, said, I'd just like to have access to it. But do you actually take money out very often? No, but I just want to have access to it. But they won't tie it up, say, to a 3-month account or a 6-month account. You know, they want it in instant access, but it's earning like almost 0%. And anyway, even with the money that you tie up for 6 months, you can still get the money. You just lose interest if you pull it out. It doesn't mean it's locked in forever. You know, so use some of these fixed term schemes, a bank bond or something like that, or a fixed term ISA to get a higher rate of return for your money. I did a 1-year ISA a couple of years ago. I got quite a good return. You know, so look at that sort of thing. And if I withdrew, I can still get the money if I need it in an emergency. I would just lose interest on it, lose some of the interest that I've got on it. So it's not the end of the world. Alternatively, the third thing is you can look at moving your money out of deposit accounts where your money has been eaten away by inflation at almost 10% a year. So if you've got 100,000 sitting in the bank, by next year that's really going to be worth £90,000. Not on paper. You'll say, oh, still got £100,000 here, Charles. No, it's not. But what can you buy with that £100,000? £90,000 worth of goods, because inflation has made everything more expensive, and the real rate of inflation is probably nearer to 20% if they calculated it in the way that they used to calculate it before they fiddled the figures. So look at that. Look at other ways of investing money. I mean, not everyone wants to go into property, but property is certainly a way of putting your money into something that gives you a return on your money anywhere from 3% in the city areas up to 14-15% in the northeast. And certainly we've got deals on Open House South Hart's Facebook page offering yields of between 10 and 15%, offering properties up there on auction, starting bids at £29,000-30,000 for a house. Some of these houses are already let. There's a house on there for £30,000 already let at nearly 400 a month. There's tenants in there paying rent, and that's I think that worked out at over 10% yield, something like a 12% yield. I can't remember exactly what it was, but it's certainly a better return on your money than sitting in the bank. Even if you've got management charges, even if your boiler breaks down, and so your yield is not okay, it's not 12%, it's 9%. That's 9 times, it's probably more like 18 times the amount you're getting in the bank, and the bank is not giving you any growth either. So to look at that, I'm not your financial advisor. I'm not telling you to move your money into stocks and shares or property. You've got to talk to your own financial advisor about this. But certainly you can't just afford to let your money sit there in cash forever. I mean, if you're waiting for the market to drop, like the stock market, and waiting to put your money in the market, fine. But a lot of people have been sitting on cash for years and years and years, and they're literally running out of money. I want to bring in somebody next week to talk about equity release, because that's another way of pulling money out of your equity in your property. If you're a little bit older, maybe in your 60s or 70s, you can pull out equity from your property and use that money maybe to buy another property. Use it to help your children buy a property, your grandchildren to buy a property, or just use it to live on, and then that money will be then eventually paid back when you die or when you sell the property. So those are some of the alternatives for you. But obviously this is a property podcast as well as money. So I'm obviously going to talk about the attractiveness of investing in property, using leverage to buy a property. So I've got to talk about that. Now, mortgage affordability rules have been relaxed by the Bank of England, as I said. This is a so-called stress test that required mortgage lenders to calculate whether a borrower applying for a mortgage could still afford that mortgage if rates went up by 3%. Now, that didn't happen since they brought this in. This goes back to sort of 2014, and rates have never jumped that high. So they've kind of relaxed that rule. So it might help borrowers who previously found it difficult to get a mortgage, like freelance workers, self-employed. It might help them. But other rules, there's still rules in place. I don't think lenders are going to immediately start throwing money around because they're being a bit more careful than that at the moment. But it has been a barrier for borrowers. It made life difficult. They got rid of all of the things like self-certification mortgages, where you could sort of certify your own income. They've got rid of that. There's very few 95, 100% schemes around. I did tell you about one about a week ago. But I don't think they're going to immediately change this. But because lenders still have to have strict guidelines as to how many borrowers they can have with 4.5 times the borrower's salary mortgages. So there are these still restrictions imposed by the FCA, Financial Conduct Authority. So just watch out for that. Now, property prices, as I said, could fall if there is a recession. Interest rates keep going up. Property prices could fall back a bit, but they've always come back in the long run. And property prices falling, frankly, is great news for property investors, because it means it becomes more of a buyer's market rather than a seller's market. In the last few years, you wanted to buy a property, they're kind of putting you on a waiting list, But there's very different areas of the UK, and I've already mentioned the northeast, where you can pick up properties at £30,000. And those prices don't fluctuate too much. They are going up, actually, because there's a lot of money being pumped into that part of the country under the government levelling up scheme. But then you've got London and the southeast, where houses are £500,000 upwards and that sort of thing. So they're very different areas, and that parts of London have gone up sharply and come down a bit, but they still always recover. There's always jobs in these parts of the world. The economy is stronger in the London and the southeast than it is in the north. But you've got to take your choice, really. If you're looking for income, then maybe a property up in the northeast yielding 10% is the right thing for you, but it's not going to give you huge growth that you would get on a property in London or the southeast. But look, if you want to find out more about how to invest in property, how to get started, then there is a free training coming up next week. I think it's next Wednesday at 7 p.m. Free training, beginners property secrets, learn from experts. It's designed for those who are starting out and want to get started in property but don't quite know how, or people who think that the only way to get started in property is if you've got to have a lot of money. Not true, not true, not true. You can get started in property with no money. You can certainly acquire properties with no money down. There are lots of techniques for that. You can control property and earn money from property without even buying it. Options, rent to rent. There are lots of different schemes out there to help you get started in property. Rent to own is another method where you might be able to get on the property ladder. I talked about this in my 6 tips to get on the property ladder. I'll put a link up for that. But look, if you want to join this free training next week, lots of my clients have. I don't even run the thing. I just pass it on to somebody. But lots of people have found it useful. And who knows, you could be the next success story. You could be my next success story who goes from zero to property millionaire in the next 5 years. Who knows? I've seen people do it much faster than that, actually. I've seen people come behind me who've started with nothing and overtake me, and suddenly they've got 30 or 40 properties, and good luck to them. You know, they're building their own future. So let's not get stuck in this recession mindset that it's all over. You know, Britain always recovers, property always recovers. Even if the stock market goes down, that's the time to pick up bargain shares, and things will recover. You've got to have faith in the Western economy, even though there's lots of problems in the world. There's wars, there's food shortages, there's famines, you know. But look, oil prices have come down, right? So we have got some good news to report. And as I said, if property prices drop, to me, that's good news. That's not bad news. It actually helps people get on the ladder, and it helps investors get a better yield on their money. So now's the time to learn about property investing, so that when things change, you're in the zone, right? You know what's going on. You're not waking up 3 years' time saying, oh, property prices fell, I should have bought something. No, because you'll be with getting around people that know about these things. You'll be in groups that tell you, look, come on now, let's do something here. There's lots of joint ventures going on as well in these training groups. So get in there. It's a free training, virtual training. You've got nothing to lose, everything to gain. So do that right now. Register your interest, and I wish you good luck in your property investing journey. But if property is not for you, that's fine. Carry on doing what you're doing, and just keep listening to my podcast. Keep sharing, liking, all that sort of stuff. So thanks for listening. Have a great day wherever you are, and do join that free training. I'm sure you will not regret it. Thanks very much. Bye for now.